Hello everyone, I'm Kyle Cheropita and this is The Upside, coming to you from Montreal today. So on this episode of The Upside, we'll be looking back at the month of March with some key FidelityConnects highlights that help shape the recent market story. FidelityConnects is first presented as a live daily webcast for financial professionals, but is then publicly released on replay as a video podcast with new episodes dropping daily. In early March, we hosted an extended webcast focusing on geopolitics and the markets, which has certainly been a big topic lately with many intricacies and sensitivities. We'll start off today with a clip from that show featuring Global Natural Resources Fund portfolio manager Joe Overdevest and energy equity research analyst Jin Wang joining host Glenn Davidson to discuss the current state of the energy sector amid these international conflicts.
I think we'd be remiss if we didn't talk about how you as an analyst and you, Joe, as a portfolio manager, deal with news as it accelerates like we've seen over the last several days. Jin, maybe I'll start with you. How did you react when you saw what was going on with the news in general and energy?
Yeah, certainly a busy weekend. The first thing, funny enough, is actually just turning off the news. It's taking a step back and understanding what this actually means. Our training is specifically in understanding equities and what's priced into equities. So turn off the news, refresh your models and understand what type of oil environment are these equities pricing in today and being able to action against that. Once you have a good understanding of the starting point, from there you can start analyzing all the different developments. And for me personally, I have my own work that I kind of do in the background, but just as equally, we have a ton of analysts around the world. This is not just a conflict in energy, it's actually kind of wider reaching. And we have tanker analysts out in Asia, we have different kind of chemicals analysts out in Europe, and speaking to them and understanding exactly what the implications are across the supply chain and bringing that into the analysis and bringing it into the work that I did prior.
So you've got a lot of great partners around the world.
100%.
I like what you said, turn the news off and then figure out what does it really mean from a quantitative research, from a fundamental research standpoint, and stick with the models that you've created as well. Joe, you've got experience as an analyst in the past and also many years as a portfolio manager. How does your day change? I know you're both very busy anyway, but how does it change when things like this go on?
Well, Saturday morning at 6 a.m., the priority is to read and to read about this. And so what my normal reading would have been was definitely prioritized for the more recent events. And I think I loved it is obviously we read the public news, but as you said, having a rock star analyst like Jin, but more importantly, multiplying Jin to 1,000 investment professionals around the world, hearing what people are saying globally in Fidelity about this event, and more importantly, putting in perspective. Again, I've lived through, sadly, certain events like this before, but also others have as well. And what is the precedent? Is there anything we can look towards is what more importantly for our clients will happen going forward? Because that event has already happened. Where is the opportunities? And so using all the analysts, a lot of Teams messages, a lot of calls, a lot of talking with PMs and analysts. And I like that as well because it's not just the analysts you're talking to. We have this big team and PMs look at different angles, growth, value, sometimes just sector specialists. Really rewarding as someone who loves research and loves being very intellectually stimulating at a very dynamic time.
Jin, Joe called you a rock star analyst. I could just picture, because just to paint a picture for our viewers, you all sit in an open concept environment. You must have had the lineup like you're the next best coffee shop in town. Everybody's saying, I got to talk to the energy guy in particular in an environment like this, but there's just a free flow of information, isn't there?
Yeah, and I'm incredibly fortunate because before me, there was another energy analyst. Before that, there was another energy analyst going all the way back to kind of Joe's days covering the sector specifically. So to Joe's point around understanding historical precedents on these types of events, I'm able to call up the analyst that was dealing with the US invasion of Iraq or even the Russian invasion of Ukraine to understand how do these equities actually trade. And that positioned us that much better than any other investment firm because we have that institutional knowledge all kept in-house, and I can leverage that as the current analyst.
You'll always remember these days, Jin.
100%.
Okay, let's talk about, from your perspective, why is it seems it's always about oil, and what are the ramifications for the market right now, based on what we know?
Yeah, so the conflict can kind of be divided into two pieces. The first that everyone is really focused on is the Strait of Hormuz, which transports 20% of global oil shipments every day. The other piece is the broader conflict, which could be kind of longer in duration than we think, but everyone for now is focused on that first piece. And the reason that everyone is so focused on this is, look, the energy markets globally, they're balanced on a knife's edge. Plus or minus 1% of supply demand can actually mean the difference between $50 versus $80 oil. So as we think about the two components, the Strait of Hormuz, I think most incentives are there for kind of oil to keep flowing, whether it's the US needing kind of lower oil prices or Iran needing effectively oil export revenue to fund the war. That I think most people are generally confident in. The bigger piece is what happens with the broader conflict and how long that can go on. And as we sit here today, we try to understand what type of oil price environment are we in, what are the equities pricing in, and are they effectively pricing in those two components that we're looking at right now.
Connor Gordon and Chris Malodzinski are co-portfolio managers on Fidelity Global Small Cap Opportunities Fund. Their new market narrative is moving away from a world of cooperation to competition. With that and renewed volatility in the marketplace, they joined Connects to share where they are finding pockets of opportunity to remain cool amid the chaos.
Connor, it's a very concentrated portfolio. I believe it's 90 or 94 names. And it's also, you're both looking for names that are less connected to the overall market. Can you talk about how you came up with the whole concentrated vibe of the portfolio?
Yeah, I think Chris and I kind of split the fund, but our name count tends to, at the tail end tends to fluctuate. But the way people should really think about it is, Chris and I are trying to build each of us have our top 20, 25 ideas. And then there's a tail of things that each of us is, maybe we're working on with the analyst to build conviction to size up. Maybe it's a stock that we've held for 2 or 3 years and it's mature and, our prospective IRRs are no longer attractive and that's kind of moving out, right? But really think of the core of the fund being, the top 40 to 50 stocks, I would say. And what we're trying to do is really isolate our best ideas and really have those ideas have impact on the fund. So we often kind of say we tend to have spheres of influence, right? Chris often will kind of slant more toward consumer and financials, and I slant more toward industrials and tech, which is a reflection of kind of the historical experience that we had as analysts. But that's really from a concentration perspective, we're trying to have the top 40, 50 stocks rise. And then as Chris said, from a risk management perspective, is we are always trying to have what we call value at risk. So trying to give each position a risk budget so that no single security, we're not going to get knocked offside by any single security is really what we're trying to do.
That makes a lot of sense. There's also the inflection point, Chris, that you're looking for. Yeah. And I'm sure what our viewers find really interesting about the both of you and your fund is you're investing for the future. You're really looking for companies that, as you've said before, are on page 16 in the newspaper today and they're heading towards page 1. Yeah. Can you give us a high level on how you calculate where an inflection point is for when you want to be investing?
Yeah, so it's not really a quantitative calculation. It's generally, if you look at the business history, there's something going on in the business where in 3 years' time it's going to look a lot different than 3 years prior, right? So you can think of a management change, right? A new CEO that comes in that replaces a terrible CEO. Well, obviously the business going forward is probably going to be run better than it was in the past. If a company sells a money-losing division, the earnings power is probably going to be much better in the future than it was in the past. And so when you underwrite the businesses and you take positions when the business is undergoing an inflection point, it also lowers your risk because positioning is a lot cleaner, right? They generally have positive earnings revisions and stocks follow positive earnings revisions. So that's what we're looking for, looking to underwrite it at a very attractive valuation versus its history, as well as when it's undergoing positive earnings revisions.
I'll maybe just add on that, I think what we tend to, people often think about when we're investing globally, think about diversification from a geographic perspective, from a sector perspective. We also think of it in terms of an idea diversification. So Chris kind of, you mentioned inflection points. We tend to bucket them in 3 buckets, right? Which tends to be structural inflection points, cyclical inflection points, and idiosyncratic inflection points. So structural tends to be things like changes in technology, changes in consumer behavior, changes in government policy, right? Things that are happening more. Some people might call it macro. I might call it more like thematic or trend change. And then cyclical tends to be, inside of an industry. Obviously there's things like industries like maybe like housing, right? Industries that are naturally cyclical. We're kind of looking to buy things when they're depressed and sell them when they're exuberant. And then idiosyncratic, which Chris touched on, which tend to be very company specific. Management change, restructuring, things like that. And when you bucket the ideas into idea buckets, it also adds another, what we believe, another added layer of diversification.
And risk control.
Exactly.
Yeah, and this is what you've considered a transatlantic portfolio, where you've got Canada, the States, Europe primarily. Yeah. Yep. And then some other economies, like I noticed Japan's in there at around 6% or so. They come in once in a while. But first question would be, that's stock driven though, not a commitment to a certain market, I'm assuming. But also, how have you relied on, or how did you come up with Canada, Europe, US as the primary components? Chris, I'll go to you.
Well, again, we invest where we have an edge. We obviously do a lot of due diligence. It's all bottom up, idiosyncratic, right? So they're companies that we really understand, have a history with, and that generally leads us to the transatlantic nature of the fund, right? We're spending more time in Japan. Emerging markets will probably be generally de minimis over time. So we want to build that experience with companies over in APAC, and hopefully over time increase that exposure. So that's kind of the goal. And but in general, I would say it should be like 50 to 60%, North America over time, and then the balance Japan and Europe.
And Japan had a great last 3 years, so that worked out well.
Yeah, I think just to add on to that, I think when we're always approaching the fund less from a geographic perspective and more from a sector perspective. So when we're looking from at businesses, most of the businesses we're investing in tend to be global businesses. So even when you're, we own companies in Europe, for example. You just look at our top 10, right? You take a company like Weir, which does mining capex. It's based in the UK. Well, guess what? There aren't many mines in the UK. So, this is a business that's based in the UK, sells globally. It just happens that, their headquarters are based there. So we're focused more on the sectors and trying to find best of breed companies inside those sectors, regardless of where they happen to be headquartered, rather than making an explicit bet on an international domestic economy.
So next up, we'll hear from Fidelity Insights class portfolio managers Nidhi Gupta and Matthew Drucker, joining host Agnes Doherty. After an extraordinary 40-year career at Fidelity, portfolio manager Will Danoff will retire from day-to-day portfolio management at the end of 2026. Will Danoff will remain at Fidelity in an advisory role, ensuring that his investment knowledge continues to make an impact on both the organization and investors. Nidhi and Matt currently co-manage the fund alongside Will, and will continue to hold the co-manager positions following his retirement. Take a look.
One of the things that's really special about this journey to now co-manage with her is we grew up as investors together. We covered a lot of different stocks. We managed select funds, and we had the opportunity to work more and more closely with Will over time. I became a diversified co-manager with Will 2 years ago. So I joined 4 years after Nidhi. And I think Will selected both of us because we're drawn to the same core philosophy that stocks follow earnings. And we also have the same process that focuses on staying close to the industries, working with our very strong team of Fidelity analysts to find opportunities. And we know how to work with the team because we were both analysts for the better part of a decade and a half. So we're spending time together, meeting with companies, including quarterly callbacks. We're continuously seeking to identify stocks where growth is underappreciated by the market, either in magnitude or durability. And I think with two of us as co-PMs, we can cover even more ground. But growing up as investors at Fidelity, we've been through a number of very different market environments. Early in our careers, we were actually interns in 2007 before the financial crisis. So we started in our seats as that, GFC unfolded, and that was a formative experience. At the time, I covered consumer discretionary companies, and I remember Will reminding me, Matt, restaurants could be the canary in the coal mine for consumer sentiment. Consumers are 2/3 of the economy. When they start to feel less bad, you might see it first, like at a splurge for better coffee in the morning. So we started, tracking store level activity at Starbucks very closely. And sure enough, when same store sales, stopped getting bad in March 2009, that turned out to be one of the earliest signs that cycle had bottomed. And that early experience really reinforced how closely studying businesses can give you an investment edge. And of course, the real highlight was going with Will to meet Howard Schultz and dig into Starbucks' plan to sustain growth even after the stock had more than doubled from the lows. Will always says, just because the stock has doubled doesn't mean you've missed it. We didn't miss that one, but as Nidhi said, over the next decade, I went on to cover other sectors, communication services, and tech and communication services are now about half the market. And, over the time covering tech, we've seen these large digital platforms has really given us a front row seat to several major technological transitions, from the rise of the internet, the mobile internet, cloud, the evolution of digital advertising and video streaming. And now we're in this next phase as generative AI begins to reshape many industries and drive a big part of the economy. So we feel well prepared for that. And just throughout all of these environments and investment trends, the constant has been working closely with Will, and his approach has always been bottom-up fundamental research and a simple idea that over the long run, stocks follow earnings. And that philosophy's guided the fund for decades, and it will continue to, even when Will steps down from his active PM role to become an advisor at year end.
Well, there's no doubt that Will Danoff has been one of the most successful franchises here at Fidelity, and it's so incredible. You two are the stars that have been chosen to take over the reins, and it's so interesting listening to you speak, because I'm hearing things like, you grew up together in Fidelity and working alongside Will and his team. It sounds like there's such an inherent strong team approach to everything, and Will has really sort of institutionalized his way of thinking. So Nidhi, if I could pass the next question to you, I'd love to just hear a little bit more about your experience working with Will Danoff, and what are the sort of key elements of his process that you're going to continue to carry through in the Insights Fund today?
Yeah, Matt mentioned one of them, which is stocks follow earnings. So that, that means we're doing bottoms up research. We're working really closely with the research department, which covers over 2,000 stocks globally. And as Matt mentioned, we've been in the trenches with the research department, so we have close relationships there. And then Will's other philosophy is keep turning over rocks. Keep looking for ideas, keep learning from companies. And for Matt and I, we sit right next to Will. Will sits right there. Matt sits on the other side of him. And, just this mantra of keep turning over rocks, that's kind of the air Matt and I breathe every day. And we have been for almost 20 years. So we spend a lot of time meeting companies in our offices. We're usually packed with a schedule of back-to-back meetings with CEOs and CFOs on a daily basis in our offices. We're very frequently traveling to meet companies at their offices. Matt and I are actually going to go to California with Will next week. We're going to meet with industry leaders, and we're getting a front row to these executives and founders and what they're trying to build, and that's extremely valuable. I mean, at the end of the day, this is a people business. You're all trusting us as fund managers, and we're in turn trusting these founders and CEOs to build these businesses. And I think that trust takes time to build, and it's something Matt and I have worked hard at over our nearly 20 years at Fidelity.
Portfolio manager Hugo Lavallee manages several funds, including Fidelity Canadian Opportunities Fund and Greater Canada Fund, the latter which can invest up to 49% out of Canada. On his Connects appearance, in both English and French, he highlighted the shifts he's made to his portfolio and how he is interpreting the current economy. Take a look.
Almost 2 years ago, you talked about making a change to energy and hard assets because you are a contrarian investor, and you got up on that stage and you talked boldly about what you were doing and what you were planning to do within the portfolio. And we sit here today, and you do consider it a wartime portfolio, wartime economy. Please tell us your thinking and what that means for investors.
And the thematic for me and my funds really accelerated last fall, like around September. And I might need to come up with a new term than wartime economy, because that took a new meaning 10 days ago. But if I was referring to wartime economy and hard assets in January, let me explain what I meant by that. And as you said, barriers are going back up, distrust between trading partners, addressing critical points in the supply chain, reshoring, energy security, national security, defense, critical materials, hoarding of assets, hoarding of commodities. That's a very important one. And this conflict and hopefully it's going to be just like a little bit COVID and Liberation Day. It's a storm that comes and hopefully goes, right? But nobody comes out of this thinking these thematics that we've been talking about, they're still not on trend, right? If you're Taiwan and you get 40% of your nat gas from Qatar, you've got a problem. If you're Europe and you went from Russian gas to some Middle Eastern gas, now you realize we also have a problem. There's a big game being played here. Let's not be blind to, China imports 3/4 of their energy consumption, oil consumption, right? And they were getting a lot of that energy from Venezuela and Iran. And all of a sudden the Americans are there, right? So let's not be blind to these facts. And I think what's happening is this wartime footing, this hoarding of assets, this energy security, national security, post this event, is these thematics are accelerated. Getting out of US dollars. If you're some of these countries, you're not trying to sell your oil in US dollars. If you're some of these countries, like Canada, the capital will be asked to come back. Why are you investing in real estate in New York? Ontario teachers, Caisse de dépôt, bring the capital back. We need infrastructure. And I think that the conclusion to all of this in a hard asset market and a wartime footing economy, I think it's good for Canada. I mean, that's the bottom line. And I think the funds that the way I'm running them is it's very different than the last 10, 15 years, right? So I took Greater Canada in November 2011 and basically been overweight US all the way till last fall. I wish I would have done it 6 months earlier, and I think it's a big change. And I think what's worked, this asset light businesses the previous 10 years, I think it's being replaced by asset heavy. Even tech, right? If you look at the Mag 7, 6 of the 7 Mag 7, basically all of them except for Apple, are investing heavily in CapEx and shrinking their free cash flow yield. So I think it's just a different world, and we're trying to change with it. And what's happened last week, I think will just show again just how intertwined things are, and governments will try to make ourselves more independent from one another. So I think what it means for Canada, it means infrastructure. If we can fight a little bit less between provinces, and I include the one that I live in, I think the world needs what we have to sell. If you just look at LNG, for example, it's United States, it's Qatar, it's Australia. I think I'm not mistaken, these three are over 50% of LNG exports. Like Canada's not even close. So I think there's a lot of things that we can do better as a country, and we're trying to get on trend for these things.
Tom Stevenson, Investment Director at Fidelity International, joins us regularly on both Connects and the Upside. And here on Connects Mid-Month with Pamela Ritchie, Tom touches on diversification and the 60/40 portfolio in 2026. Enjoy.
Let's speak to diversification within investors' portfolios. For those that often have looked at the 60/40, much of that still works. I think there's just a different calculation of risks probably that you might outline. So for those that maybe have diversified on the equity side of things to either international, do you think the 60/40 is still a good way to look at things? We've been talking about this for a while. I just wonder if it comes into a different leitmotif now.
Well, I mean, I think, we talked about 2022 and, 4 years ago, being a different world, but in some ways it was a similar world with regard to that 60/40. Yeah. We had both equities and bonds underperforming at the same time. And that traditional diversification through the 60/40 portfolio didn't work for a 12-month period. Now, I think if you fast forward to today, we have another situation where, frankly, it feels like the correlations between bonds and equities are going to be positive again, because the factors which are driving bond yields higher, the higher oil price, higher inflation, are also negative for the equity market. So I think, we are going to see a period of time when bonds are not a great diversifier against equities. Now, bonds do have some attractions because, self-evidently higher bond yields is attractive to a bond investor. And you look at the 10-year bond yield in the UK, 4.75%. I mean, that's a very attractive yield. So I'm not sort of dismissing bonds within a portfolio, but I think that they are going to struggle to perform their traditional function of being a counterpoint to equities. I think investors are going to have to work harder to get that diversification. They're going to have to look at things like infrastructure, precious metals, absolute return funds. And I think for a personal investor, that poses some issues, because those more illiquid markets, that can be quite difficult to get into as a private investor. It's not as simple as just buying 60% equities and 40% bonds. That's a nice simple thing, and I think that simplistic diversification isn't going to work anymore.
It's
or at least for the time being.
It's interesting because some of the diversifiers, which you mentioned, precious metals, gold is obviously sort of the obvious one, and it's had huge run-ups, and actually has also had moments of leveling off. You're wondering if it's sort of touching its high levels and needs a breather, like much of the U.S. equity market, in parts of it anyway. So I just wonder about some of the diversifiers. Are there new diversifiers, I guess is the question.
Yeah, well, I mean, you mentioned gold, and I think that's an interesting one, because I feel gold has done a really good job for a couple of years, a really good job. But when I look at the history of the gold price, it does tend to go in sort of periodic moments when it spikes higher, and then you can have many years, even decades, when it just does nothing or goes sideways or goes backwards. It feels to me at $5,000 an ounce like gold has had a really strong run. And so I just as I'm slightly cautious about bonds as a diversifier for an equity heavy portfolio, I'm also a bit cautious about gold as a diversifier. So I'm looking hard at other things like infrastructure, like some sort of absolute return funds, but you're running out of diversifiers. Actually, it becomes more difficult.
Thank you all for tuning in today. Each of those clips was from a 30-minute video podcast, and all full episodes are available on YouTube, Spotify, Apple Podcasts, and more. We are putting out fresh content daily, so for more from us, please look up Fidelity Connects or the Upside podcast. The Upside, as you know, starts as a streamed webcast and is our public first show, with the goal of simplifying investing content for all of you. To not miss a live Upside, head to fidelity.ca and sign up for the next webcast or the Upside newsletter. Thanks for watching today, and I hope you'll join us again. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.